Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azuz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the August investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weiss, about what's going on in the markets and what he thinks you need to know about investing right now. Bob, how are the dog days of summer treating investors?
The summer's going great for investors. Markets have had a very strong year, and they got bumpy back in March with the bank failures, namely Silicon Valley Bank. But as we made our way through that, the last few months have been excellent.
Anything in particular jump out at you?
I'll just run through the numbers on that note. I'll read off two numbers year to date, and we're recording on August 2nd, and then just trailing 1 month, basically capture July last month, and since we last recorded. So MSCI USA, think like US stock total market, up about 20% year to date, 3% over the last month. MSCI World ex-US, so this is foreign developed countries, 13.7 year to date, 2% over the last month. And then MSCI emerging markets, 11% year to date and 5.85% over the last month. So all strong double-digit returns in equities. Emerging markets showing some sign of life over the last month, catching up a little bit, but they have been lagging the US. And to break down the US a little bit more, MSCI USA growth year to date, 37.5%, and MSCI USA value, 5%. So huge spread in growth versus value in the US, 37 to 5. And then we can't forget about bonds, because bonds are more interesting these days. Just looking at the Bloomberg US aggregate year to date, about 1.5%. So, decent return, but over the last month, negative 63 basis points. So bonds have given back a little bit with a slight uptick in rates.
So why is that, Bob? Just the uptick in rates?
Yeah, the yield up, price down. So Fed has been raising rates last week. The Fed raised rates to a 5.25 to 5.5 range, and yields have gone up a little bit over the course of the year.
So we can't really comment on why a market is doing what it's doing, or why the last month, happened to be what the last month was. But there is maybe a lesson for investors about this year in the markets. In particular, a lot of bad stuff out there, a lot of bad potentialities, inflation, rate hikes, maybe a debt ceiling debacle, recession around the corner. And markets are having a very strong year. I think one of the strongest years in recent memory. So how do you process that as a chief investment officer, and how do you counsel clients and individual investors to think about a year like this? What lesson should they take away from it so far? I know we're not done the calendar year yet.
Yeah, it's a great point. And I'd add bank failures to that list too, as we mentioned earlier. So there's been a lot to worry about, on recession watch and inflation, the highest we've seen in decades. And I think a good takeaway for investors, something to keep in mind, is it's not good or bad, it's better or worse. And when you have bad, but bad gets less bad, i.e. better, which is the story of 2023, that typically means rising stock prices. So when you have a lot to worry about, there's a lot of room for things to get better. Really, one of the times when you should be the most concerned is when you have nothing to worry about, because then it can really only get worse if everything's perfect. So there were a lot of concerns in markets, like inflation was high, but that's come down. It's still above the Fed's target, but it's gotten better. Recession risks were elevated. They're still out there, but they're not as high as they were before. So, bank failures were happening, and there was a fear that they'd spread and have a greater impact on the financial system. That didn't pan out. So we've had these risks, and the debt ceiling. Those things come and go so quickly that, as we're going up into it, we're fielding a lot of client questions. Everyone was so worried about it, and it passes, and that's behind us for now. So I think just a takeaway for our listeners is, when you're worried about markets, your human instinct is to act and, oh no, like, get out of markets. But that means there's a lot of room for improvement when there's things to be worried about, and markets go up as conditions improve. And that's what we've seen this year.
So is this a case of there was a lot to worry about and it just didn't materialize as badly as maybe market participants were thinking, or that if you're expecting the worst and it comes in a little bit better, that's a great rally point for markets? Or are those both the same thing?
Yeah, I think same thing, maybe a little of each. And there's a lot of topics there. Like on the banking failures, I'd say that kind of didn't pan out to be a main event. Things like recession, it still could come in 2024. Thinking the odds are close to 50-50 on that, soft landing versus probably more mild recession. And inflation is still a little elevated, has been coming down. We're starting to see some concerning data that, it might be hard for the Fed to hit 2.0%. They've got it down to 3, but that last step may be difficult. So higher rates for longer is definitely in the cards. So risks remain.
What do you think the Fed is going to do from here?
Yeah, it's a tough one. But at the next meeting in September, it's I think most likely a pause, a hold, whatever the terminology is, just leave rates as is. And then in the meeting after that, the November meeting, I think it's looking like a 50-50 chance of a rate increase. And but the Fed would say data dependent. It depends a lot on what data comes out between now and then. Two things that caught my attention are oil prices. So oil was in the 70s, and then it spiked up to the 100 level in 2022 when Russia invaded Ukraine. And then it dropped back down to the 70s. So you had a big year-over-year decline in the price of energy when you're doing 70 divided by, say, 110. But in the month of July, oil went up about 15%. So back up into the low 80s. So just when you see, 15% move in oil to the upside, that just flows through to so many parts of the economy. When you're looking at inflation, like think of transportation costs, whether you're buying a plane ticket to go on vacation or getting food imported from, South America, just goods being transported across the world. So, and then oil's in a lot of products too. And part of that, what caused the increase in oil, kind of slightly depressing headline for, especially the climate. We set a new record for global oil consumption at over 110 million barrels a day last month. So, there's long-term chart of population growth and have been consuming more oil. But then when COVID hit, things slowed down and oil consumption declined, and there's been a trend towards alternative energy. But people are traveling again, and summer's been active, and we're using a lot of oil. So that's led to an increase in oil prices. So anyways, long-winded way of saying that's something to keep an eye on, and hopefully we see that stabilize and even decline, because that's an inflationary risk. And the second inflationary risk is housing. Mm-hmm. We saw a stretch of, depending on how you measure it, about 7 to 8 months of declines in housing prices. And you don't want declines in housing prices, but more stability. And then the last few months have been accelerating. And we recently received the May housing report, and in the month of May, housing was up 1%. And when you're trying to target like a 2.5% annual pace of inflation, you shouldn't be seeing 1% jumps in a month. So a little more anecdotal, just, seeing transactions in my town, you're seeing the bidding wars are back, eye-popping valuations. So there might be more to come there. So, the Fed definitely doesn't want housing inflation like we saw a couple of years ago. So that's something to keep an eye on.
So it sounds like you're a little bit more concerned about the inflation fight since maybe the last time we recorded.
It is, yeah, I am. And it does kind of play into what the Fed's been saying. When you look through history, like in the 70s and 80s, inflation came, they fought it, and they started to take it easy, and it came back. The saying is inflation sticky and persistent. So they got inflation from 9 down to 3, and the target's 2. So it's like we're at the goal line. But as we're at the goal line and about to get to 2, you're seeing housing go up 1% in a month. You're seeing oil go up 15% a month. And you can kind of cheat with the CPI math when you do the 12-month numbers. So July of 2022, the CPI reading was 0.0%. So when the next CPI report comes off, a 0 falls out of the math, and whatever July comes in. And knowing that oil was up about 15% in July, and you have a 0 falling off, there's a pretty good chance that CPI is going to go up. After all these months of going from 9 down to 3, I think we're going to see a little increase. So it's just something to keep an eye on, and the Fed may not be done, may need to keep rates at these levels or go a little higher.
And what is the market saying about where Fed rate expectations are going to be?
Yeah, it's a low probability, but leaning towards an increase. Like an increase is more likely than a cut in September, but the most likely market implied outcome is nothing in September. Okay. And then the most likely outcome, it's like a 50-50 chance of a 25% increase, 25 basis point increase in November. And then the market gets to pricing in cuts in 2024. And as you go further out, like to the end of 24, pricing in several rate cuts.
With energy prices being so volatile historically, and housing being in a little bit of this weird environment where rates are higher, housing affordability is down, but inventory is so low, so prices look strong. Has the Fed talked at all about either of those dynamics and maybe looking through them as they worry about inflation?
I know they do tend to model around energy, like look at core inflation, and that drives people bonkers, like core, which is X food and energy. And they do it because food and energy are very volatile. And you have the rebuttal of, but I mean, I can't live without food and energy. But they're definitely aware of that. And, a one month move in energy price is something to keep an eye on, but not act on. Housing, it is tricky. I have a chart up to put some numbers on that. Active home listings is about 17% below where we were a year ago. 770,000 in the month of July. And over the last 3 years, the average amount of homes on the market in July has been around 900,000 or so. So you definitely have low inventory because people have their 2 or 3% mortgage, and it makes a big hurdle. I was talking to a friend the other day, and he said I'd move if I didn't have a 2% mortgage. But to sell a house with a 2, to buy a house with a 7% mortgage, that's costly. So yeah, you have tricky dynamics there. What's interesting, and I wonder what would happen if rates declined to the housing market. You'd see those people who are holding on to their mortgage, they'd move. So inventory would loosen up. But
I have seen one commentator talk about that the best thing the Fed could do to help inflation is to cut rates to get more homes listed, to make pricing more equilibrium between buyers and sellers.
Yeah, it's definitely a challenge in the housing market, and the lack of supply is causing a problem.
Yeah. Staying though with inflation and central banks, the US is doing things a little bit differently than the rest of the world, right? Or at least parts of the world.
Yeah, I think in general, the world is battling inflation, and the US central bank, the Federal Reserve, was quicker to act, more aggressive to act, so raised rates higher and sooner. And the US is benefiting from that by seeing lower inflation compared to other parts of the world. And other parts of the world now, the central banks are kind of playing catch up to the US and almost maybe watching what happened and saying, oh, that is working there. So almost following the US with a bit of a lag. So relative to it's tough to kind of just speak in total aggregate, but the US, I think central bank has done a pretty good job compared to other banks, central banks, in combating inflation.
You touched on something in the open about the difference in performance between value and growth stocks, which was pretty dramatic. But I know in talking to you, you've recently seen some data that would just put that into perspective a little bit in terms of what the future opportunity is, how expensive those segments of the market are. We are value investors, or at least we focus on valuation. So, this type of environment is important for us to kind of analyze and understand a little bit more. So talk to me a little bit more about what you're seeing in value versus growth. And maybe, again, a quick reminder for our listeners, the classic definition of a growth stock versus a value stock.
Yeah, sure. So a value stock is a company that trades at a kind of an attractive price, a good value. So you can look at it price to earnings, price to book, but relative to fundamentals, the price is low for what you get. Whereas growth, the price is high relative to fundamentals. And why would you pay a high price? Because you think it's going to grow. So you pay a premium for growth stocks because you think you're going to see higher growth, and you get value stocks at a discount because you're not as optimistic about the growth there. So the data you're referencing, a JP Morgan chart looking at the average price to earnings ratio of value stocks over the last 25 years, and it's about 14. And the current forward price to earnings ratio of value stocks, and it's 14. So value stocks are average. They've been at 14 over the last 25 years on average, and they're at 14 right now. Growth stocks over the last 25 years, the average is about 20 times earnings. So growth, as by definition, is more expensive than value, as it should be. So growth, the average is 20. Right now, it's 27 times earnings. Mm-hmm. So, and I mentioned growth is up over 30% year to date. Well, that's basically how you get from a 20 PE to a 27 PE. So growth is expensive, of course, to value, as it should be, but it's also expensive to just kind of growth on average over time. So when you look at the markets, that pocket, that segment of growth, especially large cap growth, where you've got some of the big tech names that have done very well this year, they do stand out as outliers compared to history. So an area to just be a little cautious in, I'd advise.
And it wasn't supposed to be that way this year, right? We were hearing the last couple of years about some, I would consider, new concept that growth stocks are long duration stocks, or is it value stocks are? What was this nonsense, and why didn't it pan out?
Yeah, so I first started hearing this argument a few years ago, and what you're getting at is if you have two companies and one is highly profitable today, call it company A lot of cash flow coming in today to investors, and another company isn't profitable today, but they're going to be profitable in 5 years, in 10 years. Like down the road, they're going to be making a lot of money for you. They're just not there yet. As an analyst, when you're valuing those companies, the common way to value a company is like what's called a dividend discount model, where you're discounting future cash flows to a present value. So you're taking the cash today that I'm going to get, the cash next year, the cash in year 3, year 4, year 5, etc., the cash in year 10, and you use a discount rate to say what's that cash flow worth today. And if you use a low discount rate, I mean, even say if you use a 0% discount rate, then if it's going to have $1 billion in profits in 10 years, then that's worth $1 billion today if you use a 0% discount rate. If you use a 10% discount rate, I'm not going to discount 10% over 10 years on the fly in a podcast, but $1 billion is worth a lot less today because you're discounted by 10% every year for 10 years. So what some people have argued is that when you have a higher discount rate, growth stocks are less attractive. Value stocks, meanwhile, they're cash flowing today, so there's not much time to discount the cash flows. And that is the case that some people made for supporting the performance of growth stocks in the 2018 period, 2018, 2019, 2020, when growth did really well because we had low interest rates.
Yep.
So as rates are low, so the discount mechanism that people use to value growth stocks makes them attractive. And I'll give a plug to DFA. I shared that research with them and said, "What do you guys think about this?" And they politely said it's hogwash. That's just something people say today, but if you test it, it doesn't pan out. And I said, "Well, show me the research." And they pointed to the 90s and said, if you look in 98 and 99, we had higher interest rates, around 5%, and growth stocks did great. So it doesn't pass the test. And here we are in 2023 with higher interest rates and growth stocks are winning. So that kind of logic of growth does well with low rates, but not high rates isn't playing out. So not to say it's like myth debunked and there's nothing to it, because there is some logic behind it, but markets are more complicated than just simply low rates are good for one segment of stocks and not the other.
And I think as an individual investor, and in your example, the value stock was company A and the growth stock was company B. But I think as an individual investor, the lesson is when you start to hear new stuff, new buzzwords, new things on CNBC, new managers talking in certain ways, whether it's a earnings recession or high duration stocks versus low duration, and it's just stuff you haven't heard before used to justify a viewpoint. Take a pause, take a step back, because it's likely not going to stand the test of time, I think. And this high duration, low duration nonsense, you're nicer about it than I am. I think just didn't make sense and didn't really pan out. So as I was preparing for this podcast this morning, I saw that Fitch downgraded the U.S. from AAA to AA plus. I don't know if I'm even saying that correctly. And we last saw this in 2011, I believe, when S&P did the same thing. Just looking at it, those can be two potential areas of concern coming out of that of a downgrade like that. One is, will it rattle markets? Because 2011 was a very tough year for markets, particularly around that S&P debt downgrade. And then the other thing is whether investors will have to sell treasuries if that AAA rating is not there. Any thoughts on that? I mean, I have a couple. I feel like the market has processed this before 12 years ago. So this time around, it's not new. And while the market is selling off today, I would consider it a modest sell-off. So I guess I don't expect as much volatility around this downgrade than we had 12 years ago. And two, I saw a note, or people are referencing a note that's floating around from Goldman Sachs saying that investors are likely not going to be forced to sell treasuries because the written mandate of owning treasuries doesn't refer to AAA securities in general, but specifically to U.S. treasuries, since it's that important of an asset class. So I think maybe in the camp of, it could generate some short-term volatility, but it's not a real game changer, and it should likely be better than what we faced in 2011.
Yeah, so what we're seeing in the market is a sell-off on the long end of the yield curve. So 10-year treasury, 20, 30-year treasury yields are ticking up. On the shorter end, not much movement from this. But I think the reason for that, or the way investors think, is if you go from AAA to AA, it doesn't mean you're going to default tomorrow or in a year. But 30 years, that carrying that risk over 30 years, it's has a little more of an impact. U.S. debt is tricky, especially to have a view and act on it from an investment standpoint because it's so long term with how these things can play out. I think I have shared a concern on this podcast before about U.S. debt to GDP being around 100%, and when you have low interest rates, 0, 1, 2%, the cost to finance that debt isn't that high. But as interest rates rise, and you're financing $30 trillion of debt at 4%, at 5%, it starts to get expensive. And interest costs are now projected to be about $1 trillion a year. And that is becoming a very major budget line item. Put in perspective, just a couple of years ago, it was in the low hundreds of like 200, 300 billion. So you go from 200, 300 billion to $1 trillion. That's a big move. And it's just projected to increase. So the U.S. does need to get a better handle on that. What's interesting when you reflect on the last few years when COVID hit, there was government stimulus. So it's textbook. The economy is at a standstill. So what do? The Fed cuts rates to stimulate the economy, and Congress has all kinds of stimulus, mailing checks, cutting taxes, PPP programs, just kind of sending money out there. And then things get hot and you have a ripping economy. What does the Fed do? They do what they should. They increase the Fed funds rates. What does Congress do? Textbook, if they're rational, they should raise taxes. And that's when you balance the budget. That's when you start to pay down the debt when times are good and things are hot. But they didn't do that. So they're not acting.
Raise taxes or cut spending, right? I mean, just pull money out of the system to balance this conversation.
Yes, raise either way. Yeah.
Right.
And trust me, I don't want to pay any more taxes, but it's like they're, willing to spend to stimulate, but they're not willing to be the bad guys because they want to get elected again to help slow things down. And that's just not good fiscal discipline. You can't have it one way where you stimulate and overspend at times, but you're never willing to, kind of recoup that in hot markets, hot economies. So there's some concern there, but I don't think you can act on that as an investor.
No, and I think Fitch references a lot of what you're saying. I read their comments, and it is more of the longer term debt picture, the lack of great governance in the US right now, these, ongoing debt ceiling debates. It's almost like it's their way of lecturing the US a little bit to, course correct on some of these things. So it is interesting, came out today. I think investors would have wanted to know about it. So I'm glad that we had an opportunity to touch on it before we finished recording. I wanted to ask you a question. Last episode of the podcast, I had on Michael Santoli, the senior markets commentator at CNBC. I know as somebody you really like watching, and you gave me a couple of questions to ask him. One question you didn't give me, which I am going to ask you though, is I asked him if he could have access to any investor, to basically ongoing persistent access to any investor to pick their brain whenever he wanted, who would it be? And he said somebody like David Tepper, the, I believe, Appaloosa hedge fund manager who now owns the Carolina Panthers of all things. Who would yours be?
That's a tricky question because with that, like David Tepper, he's a macro hedge fund guy for our listeners, and looking at the world and having views across all asset classes. That's a narrow segment of the market. Most professional money managers have a specialty, kind of an asset class they focus on, like stocks or bonds or real estate. And no matter how brilliant they may be, what I've found is they tend to have a bias towards talking their book. They're conflicted. So if you listen to a bond manager, there's a good chance that his or her advice may end up leading you to increase your bond allocation. So there's a lot of conflicts out there. I've found, to answer your question, I do like Lizanne Saunders. I think she's very balanced and maybe leans bullish, as one should. So she's typically pretty optimistic, but not always. And that's what I mean by balanced. She has a process. So she's consistently talking about the same data points rather than something new every time. So She's consistent on that front. And by that, I mean, she regularly looks at valuations, which I believe are important, but also I think more so than most looks at sentiment and like behavioral measures of markets. And that gets a little more artsy. Like it's kind of hard to, maybe measure or think about like surveys like of the crowd. But I think that stuff isn't important when you're looking at markets over shorter periods of time, because valuations can take years and years and years to play out. There's studies that show there's basically zero meaning in a PE measure over the next 1 year. If you look at a market, whether it's cheap or expensive, it means nothing over the next 12 months. Over the next 10 years, it's meaningful, but 1 year, it's meaningless because markets can be irrational for a long period of time. So that's where balancing that with sentiment comes in. And, is the crowd very optimistic and that's how bull markets run with momentum, or are they very pessimistic? And so I think she pairs those nicely, and she's not conflicted because she doesn't manage money. When you think about what her incentives are, she represents Charles Schwab, and I think she genuinely wants and is incentivized for Charles Schwab investors to have a good investment experience. And to me, that's someone who should be giving you pretty good advice.
Wow. All right. I like it. And the good news for you is her content is fairly regular and accessible. So you don't even have to use your magic wish of getting constant access to her, because her views are out there, which is great, and people can access them. So Bob, thank you for this. I really enjoyed the dialogue. I think listeners will have learned a lot about what's going on in the markets and the investment world right now, which is what we're trying to bring to them on a monthly basis through these conversations. So enjoy the rest of your summer, and we will chat after Labor Day.
Sounds good. Thanks, Amy.
How to Build Your Next Million. Heritage Financial's ebook teaches investors about the tools and strategies that can help them save, keep, grow, and protect their assets. This free ebook can be accessed in this episode's show notes and on our website at heritagefinancial.net.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast or that of the speaker are subject to change and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal.